Hello, it's a lovely good evening once again from here in Delhi, and hope as always that each one of you are absolutely fine. And that's what we pray for too, to be very honest with you. And now in this particular session, which happens to be the second session of IFRS 2, of course. So in this particular session, what we are supposed to pick up, that I will let you know in a short while. But before we delve into the second session, let me actually remind you what we did actually in the first session. Those among you who have attended the first session must have seen and noticed that we discussed the what we call objectives primarily, and had a sort of bird's eye view of the entire what we call proceedings, which we shall actually stretch further, of course, in the upcoming sessions too. And we saw that basically IFRS 10 deals with the consolidation of financial statement, how consolidated financial statements are drawn. But prior to that, we also saw that this particular IFRS also presents some guidelines to how to actually establish the principles of control, and it is not a very easy task. It is quite difficult. Sometimes it becomes very difficult and complicated to know and establish whether our entity has control over the other entity. Anyways, but the point is that if you happen to be an entity and you have under your control any entity, that means you are parent, other entity is subsidiary, then you are of course supposed to prepare consolidated financial statements. And when we prepare consolidated financial statement, what sort of accounting procedures and methodologies we need to adopt, that is going to be the crux of this particular session. So after having a good look over the objectives, the control and the relevant activities and the power, that means we have now acquainted ourselves with what we call some tedious terminologies of this particular standard, and now we can definitely proceed over to the accounting part, and wherein we are going to have a good look over the comprehensive questions, which most of the professional bodies definitely are going to actually throw in the examinations. So how the comprehensive questions are taken care of in the light of IFRS 10, that happens to be India's 10 in the Indian context. So we are going to dwell over that, and now here we start and come to the business end. Here we go. So in the last session, after having a look over what we call over some terminologies, now we are going to proceed over to the accounting part. Correct? So in this particular session, we are going to discuss, and of course we are going to take up some examples, how to actually solve the questions, how the consolidated financial statements are drawn, and we will have a good look over what exactly the guidelines of IFRS 10 with respect to the preparation of, as I said, CFS. So obviously now CFS provides some guidelines. But the point here is that if I am going to speak about those guidelines right now, you are not going to comprehend a single thing. So the best way to make you understand and comprehend actually those guidelines, it is better to take up an example and then coming over to those guidelines one by one in a step-by-step manner, so that we can easily assimilate and understand those guidelines. Correct? So you will have to write along with me. We have to write a lot. Remember one thing, we simply cannot, I never believe in what we call teachings where simply I am going to put a slide before you and the question is already solved over there. I am going to simply read out. That is not the way to actually teach, not the way to actually comprehend the things. So best way is to write, and because writing is going to make you what we call perfect. That is what my belief is. I hope many of you would agree, if not all. Correct? So here we go and pick up one example, but the topic, let me write first of all. As you know, I am very concerned with respect to the pens. Red pen I have picked up now. So topic in fact which we are going to take up today is accounting aspects. Accounting aspects. Correct? Accounting aspects. This is the topic which we are going to pick up today. Accounting aspects. Accounting aspects with respect to what? Of course, we are dealing with IFRS 10. It means we are picking up what we call topic of accounting aspects with respect to preparation of the consolidated financial statements. Correct? So how to prepare, how an entity prepares, or should I say how an entity should prepare CFS and how ultimately it will be prepared. So these are the moot points which we are going to discuss today. And for the same, actually, I'm picking up one example. I would request you to write along with me if you really want to understand it. So here we go and pick up this one. Let us say example 1 or demo 1, whatever you may like to write. Example 1, correct? In this example, write along with me, following are the balance sheets. In short form, I have written balance sheets of P Limited and its subsidiary. So question itself has given to you that P Limited is parent and its subsidiary S Limited. So we need not require to here apply the principles with respect to control, because it is already given that P Limited is parent and S Limited its subsidiaries. So their balance sheets are given to you. Subsidiary, name of the subsidiary is S Limited. Let us say, I have already told you, here we use word limited. If in your nation you are using the word incorporation, you can write incorporation. Many among you, if you use establishment, you can use the word establishment, whatever it is. We have to comprehend the gamut, correct? So its subsidiary S Limited. As at, I write the date also, as at, let us say 31st/3/2021. So following balance sheets of these two entities is given to you. In the one column, I have written P Limited, and in the second column, I have written S Limited. Remember one thing, S Limited is the subsidiary, P Limited is the parent. Question has stated it very clearly. So first of all, we shall write the assets, because as per division 2 under IFRS, we have to prepare the balance sheet. So we shall have a bit of practice. We will talk about all regarding these aspects in the upcoming videos too. Don't worry about that. So first of all, we are picking up the assets. In the asset side, first item I have written here non-current assets. I will use the short form, so please pay attention. Non-current asset, each one of you are familiar with it, so it should not pose a problem to you. Under the non-current assets, let us say first item is property, plant and equipment, PPE. Even under PPE, there are many assets, as each one of you are familiar with: land, building, plant, machinery, vehicles, furniture, etc. So under PPE, let us say there is an item, plant and machinery. I have written only one item. Plant and machinery, say, is 10 lakhs, because we have to take a simplified example in the initial stages. 10 lakh, and what should I write here? Let us say 8 lakhs. Correct? Then under non-current assets, next item I have picked up as financial assets. Financial assets. Financial assets. Under non-current assets, there are variety of items, and I have picked up one, property, plant and equipment. Another one is financial assets. Under the financial assets, I have written here very important lines. See here, investments in. Investments. I will write full form, investments in 3,000 shares. 3,000 shares of S Limited. So P Limited has invested in investee company, that is subsidiary. 3,000 shares it has purchased, and 3,000 share it has purchased, let us say, for rupees 7 lakh. Remember one thing, many students actually unnecessarily develop unnecessary confusion. The amount which is written in the outer column signifies how much you have spent to buy 3,000 shares. Let us say this share, one share is of 100 each. That means you have churned out 7 lakhs worth of money, correct? And you are acquiring only 3 lakh worth of shares, 3,000 into 100. So in order to purchase 3,000 shares, you churned out 7 lakh rupees. That is what we mean by here. Then I pick up, let us say, current assets. current assets, correct? And under current asset there are many items, but I have simply written right now here 5 lakhs and 11 lakhs. This is the initial question. We are starting right from the scratches. Remember one thing. So now we will tally it up. How much is the total? 10 plus 7, 17 plus 5. I think it is 22 lakhs. You have to be careful regarding the calculations, because sometime when you do concurrently, in fact multiple things concurrently, so it could be a problem. So just pay attention and take care of the totals. This happens to be 19 lakh. There are only 2 items. So this is the asset side, correct? Now we move over to the equity and liability side, as we call it nowadays, equity and liability. Equity and liability. Under equity and liability, let us say first item is equity. Under equity there is share capital. We presume one share is of rupees 100 each. Instead of using the currency rupee, you may use according to your domestic territory, your nation's currency, correct? We in India shall use rupees. So one share is of rupees 100 each, correct? So total share capital which I have written over here is, let us say, 10 lakhs. And total share capital of S Limited, say, is 5 lakhs. Correct? I know sometimes it becomes a little bit tedious to write all these things, but once you develop this and inculcate, should I say, this habit of writing a lot, I can bet my hair on it that ultimately you will get a vast benefit out of it. Because when you write along, then half the things you already assimilate. So that becomes all the more easier later on to comprehend the solution part. Then under equity, next item nowadays, because we are preparing in fact this balance sheet as per division 2. So traditionally we used to say reserve and surplus, but as per division 2 we generally use the term other equity. Other equity is nothing but reserves and surplus. Under other equity, let us say I have written one item, say profit and loss, or you can simply write surplus. Profit and loss account. Let us say profit and loss account balance is, what figure should I presume? Let us say 4 lakh. So there is a balance of 4 lakh in the P&L or retained earnings, whatever you may call it. And as far as S Limited is concerned, let us say it has a balance of 5 lakh. Correct? 5 lakh. Then I write here non-current liabilities, NCL. Let us say non-current liabilities are 5 lakh as far as P Limited is concerned and 4 lakh as far as S Limited is concerned. We are framing a demonstration question to understand the what we call accounting aspects with respect to preparation of the consolidated financial statement. Third item I have written current liabilities. CL stands for current liability. Let us say it has got 3 lakhs, 10, 4, 9, 22. I have to tally it also. Then I will pick here 5 lakhs. I think it will tally. So 14 plus 5, 19 plus 3, 22. And then 5 plus 5, 10 plus 4, 14 plus 5, 19. Correct? So this is the demonstration we have written, but question is not still yet over. Intentionally, I am keeping this sheet over here itself so that I'm escaped of what we call flipping through many sheets. Correct? Now, under some additional information is given. Additional information is also given. Additional information. In short form, I am writing additional information. Under the additional information, what you have been given? You have been given that P Limited acquired control. P Limited acquired control. Obviously, S Limited is our subsidiary, no doubt about that, because it is clearly given in the question. It automatically leads us to the conclusion that we are exercising control. So P Limited acquired control on which date? P Limited acquired control on 1st of April 2020. There is also another information given. P&L balance, profit and loss account balance of profit and loss account balance of S Limited, profit and loss account balance of S Limited as at 1/4/20 stood at rupees, or whatever currency you may like to, I have already told you, you can use that. We are using rupees, you can use dollars. Stood at rupees, let us say 2 lakhs. Correct? So this is the question given to you, and let us say requirement of the question is that you are supposed to prepare the consolidated balance sheet. So how the consolidated financial statements shall be prepared? That is the moot point, number one. Remember one thing, there are several ways to prepare consolidated financial statement, but we simply cannot take the easy route. There are many easy ways also to prepare the same, but the point is that we have to put up the solution in the light of IFRS 10, and whenever I would say IFRS 10, it would also stand for Ind AS 110. I told that in the beginning of the session itself, in the last session. So this is the demonstration question which I have just written. I will put the sheet over here. Correct? Now, in order to prepare the consolidated financial statement, first of all, what we should do? See here, you will have to be very, very careful with respect to all these steps. These are vital, because in order to solve the comprehensive question, you need to become very deft in it. First step, and lots of patience is required to comprehend this. Under the first step, what I am going to do, see here, your first step should be to have a good analysis of the accounting period of subsidiary company. You are more concerned with the subsidiary, remember one thing. Second important point is that whatever you are doing from the perspective of the parent company. These are the two vital clues you need to actually always keep while solving or while preparing the consolidated financial statement. Whatever you are doing from the perspective of the parent company, because it is the prerogative of, it should not the prerogative, it is the duty of the what we call parent company to prepare the consolidated financial statements. Is it clear to you or not? Now just have a look over here. Your first step, as I just mentioned a moment ago, should be to have a good analysis of the accounting period of subsidiary company. So your first step, I will write here the title also, analysis of accounting period, analysis of accounting period, analysis of accounting period of subsidiary company, that is S Limited in this case. Correct? What repercussion of this step would be? Before we move over to that part, first of all, we need to understand how to do the analysis and what exactly we mean by that. See here, in order to understand and comprehend this one, first of all, you simply stretch a line. This is the line I have stretched. Correct? Now, just have a good look over the dates which are mentioned in the question. When I say dates, that means the balance sheet dates. Question clearly states in this case that balance sheet is as at 31st of 3/21. That means that is the end of the accounting year. So closing date is 31st of 3/21, 31st March of 21. This is the end of the accounting year. Obviously, if end of the accounting year is 31st 3/21, And if I would ask of you actually to give me the opening date, then definitely you will give me a very straight answer. Sir, opening date must be 1st 4 20th. So this is the beginning of the accounting year and this is the end of the accounting year. Looks so innocuous, isn't it? Looks so innocent. Analysis of accounting period, all you need to do is to just have a good look over the ending date and the beginning date of the accounting year. Correct? After that, what you are supposed to have a look over. After that, you take into account which exactly is the date where control actually was acquired. As per the additional information, it is clearly mentioned that P Limited acquired control on 1st of April. Now, 1st of April also coincides with the opening date of the accounting year. That means we acquired control over here. This is your date of control. I will use the short form. I have already told you I'm going to use lots of short forms, so you have to be quite careful. This is date of control or date of acquisition as we would call it. And later on we will use more date of acquisition instead of date of control. Correct? Anyway, so this is your date of control or date of acquisition. This is the date on which you acquired control over what we call this particular entity and it became your subsidiary. Very important point here is that when I say we are making the analysis of the accounting period, of course the first point you need to keep track of is that you are making analysis of accounting period of subsidiary company. Number one. Second point is that we have to note the date of acquisition. This will unfold into two important segments. One, pre-acquisition period, and second one is post-acquisition period. So what you say we could not comprehend. No problem. This is the accounting period. Correct? This period is lying after this particular date. The period which would fall after the date of the acquisition will be referred to as post-acquisition period. In a layman's language, we may call it period falling after the date of acquisition. Is it clear to you? So this is the period of the accounting period. Accounting period is starting from, accounting period is commencing from 1/4/2020, ending on 31st of 3/2021. But important point is that this entire accounting period in the present case will be referred to as post-acquisition period. This you need to keep in your mind. These two words are the important crux and cogs also. So if you are able to comprehend, then it will become pretty easier for you to understand later on, which I am going to actually speak about some concepts. So this will be referred to as post-acquisition period, correct? Post-acquisition period. So post-acquisition period, as the name itself is suggesting, is the period which would fall after the date of acquisition. Point you need to understand is that in this case, this entire accounting period is a post-acquisition period. Obviously, the period which would precede date of acquisition will be referred to as pre-acquisition period. That means the period which is preceding this date, as I just mentioned a moment ago, will be referred to as pre-acquisition period. It will be referred to as pre-acquisition period. You need to keep that into your mind. Basic purpose of analyzing the accounting period is to divide the entire accounting period of the subsidiary company, of course from the perspective of the parent company, into pre and post acquisition period. Why we are doing so, that I will definitely let you know, but after a while. Is it clear to you or not? Once you have done this part, now your second part is, remember one thing, we are moving very slowly and steadily in the initial stages, so you need to comprehend each and every word in a very crystal clear manner. Now under the second point, once you have done up with the first step, now you are going to move over to the second step. The second step would be, see here, degree of control. What is this degree of control? Some of you might have got some clues. Degree of control. Before I explain this, just have a little bit of attention over here. In order to assess the degree of control, what we have to do, who are we? I've already told you the entire visualization of the question shall be done from the perspective of the parent company. So presume yourself as if you are the parent company. You are interested in assessing the degree of control. What exactly we mean by degree of control, that automatically will be understood by you within some seconds. Correct degree of control. Now just pay attention. In order to compute the degree of control, first of all, just have a good look over the total share capital of subsidiary company. This is the demonstration question which I just wrote a moment ago. This is the share capital. Total share capital is rupees or $5 lakhs, and one share is of rupees 100. Keep that in mind. So in order to assess the degree of control, first of all, you simply write total number of shares of subsidiary company. So total number of shares of subsidiary company, how much? Total number of subsidiary company. Total number of subsidiary, total number of shares of subsidiary company, that is S Limited. We can easily draw that out. Total share capital is rupees 5 lakh. Rupees or dollars, whatever you may like to write. Total share capital is 5 lakh and one share is of rupees 100 each. So which automatically means total number of shares of S Limited 5,000. Then again have a good look over the question. In the question towards the asset side, under the financial assets, we have written investment in 3,000 shares of S Limited. That means out of total number of shares, that is 5,000, which have been issued by what we call subsidiary company, P Limited holds 3,000 shares, isn't it? That means out of 5,000, B held by P Limited, that is parent, held by P Limited. Out of 5,000 shares, parent holds how many shares? 3,000 shares. Very easy, almost like a walk in the park. Then such shares which are not held by parent, such shares of subsidiary company which are not held by the parent, traditionally used to be called as minorities, but nowadays as per IFRS 10, these are known as non-controlling interest. Correct? Non-controlling interest, NCI, we normally write. NCI, please write the full form once at least by yourself. Non-controlling interest. Non-controlling interest means such shares of subsidiary company which are not held by P Limited. For simplicity's sake, we may say these shares are held by outsiders, 2,000 shares, not 12,000. Correct? 2,000 shares. Now, out of 5,000 shares, if you are in possession of 3,000 shares, that means your controlling proportion in subsidiary company is 3/5. And besides that, because there are some shareholders amounting to 2,000, they too have stakes in the subsidiary company. Since they are having 2,000 stakes, so their proportion will be 2/5. So basically, when I would say that the next step is degree of control, what does it would mean? It means finding out the stakes of the parent in the subsidiary company, besides finding out and determining the stakes of the non-controlling interest in the what we call subsidiary company. So now we have reached the position that as far as subsidiary company is concerned, this is subsidiary company, correct, S Limited. Now we have reached a conclusion that this particular company As far as this particular company is concerned, so we may say that 3/5 stakes are ours, that is P Limited, and besides that there are outside shareholders, we call them non-controlling interest, they are having what we call 2/5 stakes in this company. But the next point is why we are doing such an exercise, why we are computing the degree of control, why we are assessing it. Answer is very simple, try to understand that. It is not related to this question because I am using a rough sheet. This is the rough sheet, let us say. Try to understand some important aspects. Suppose there is a company and the position of the company is like this. Let us say this particular company or entity has fixed asset to the extent of, for simplicity's sake, let us say 5 lakhs so that computation becomes easy for me. And it has current asset worth rupees 5 lakhs. Okay, I will make it 10 lakh and current asset as 5 lakhs. Correct? Besides, this entity has current liability, or simply say liability, worth rupees 5 lakh. Liability shall include both current and non-current liability. Correct? And we presume that it has, as far as equity is concerned, equity. We know that equity has two elements. One is share capital. We presume that share capital is, say, 7 lakhs. And we presume reserve and surplus, that is other equity or reserve and surplus, well, I will write. That is, say, 3 lakhs. Suppose this is a company by the name of Q Limited. Presume for a while that in this particular company you have invested, or you have control of, let us say, what figure should I write? Okay, 60%. You are having 60% stakes in this particular entity. If you are having 60%, quite obviously that means you are not having these 40% stakes. So these 40% stakes will be considered as non-controlling interest and you will be labeled as parent. Correct? That if I will compute the ratio, obviously it will be 3/5 and 2/5. I'm trying to make you understand why we are interested in computing the stakes or the degree of control. See here, when you invest in an entity, you not only get shares, besides that, you acquire some rights in all the assets and liability. Just to clarify the point, fixed asset are worth rupees 10 lakhs. That means out of this fixed asset, your share will be 3/5 and share of non-controlling interest will be 2/5. Out of current asset, your share will be 3/5 and non-controlling interest holders' share will be 2/5. Not only in assets, even you will have to bear the liability. That means 3/5 share will be yours and 2/5 share will be yours. Suppose if I would ask you to compute your net stakes in this particular company, how will you compute? We know that assets minus liability is equal to net assets. Isn't it or not? We know this is the first thing which we learn in accounts, isn't it? Assets minus liability is equal to net assets. Each one of us know very well. Now we know in this case assets are 10 plus 5, 15 lakhs and liabilities are 5 lakhs. That means net assets are 10 lakhs. We also know that we have 3/5 stakes in assets and we also have 3/5 stakes in liability. So if I subtract 5 lakh from 15, I will be left up with net assets 10 lakhs. So I can say in the net assets of this entity, I have a stake of 3/5, which indirectly means 6 lakhs worth of net assets belongs to us, belongs to parent company. And of course, 2/5 belongs to outsider, that is non-controlling interest holders. So basically, degree of control, the significance lies in the fact that it helps in determining your shares in the net assets. Now let me stress it a little bit further. I have just told you assets minus liability is equal to net assets. In fact, we can compute our share in net assets, by adopting either of these two approaches. Approach one is like this. We can simply subtract the liability from the assets. We will be left off with net assets. We can just multiply it with our share and we can find out what proportion of the net assets would belong to parent. Are you getting my point or not? Yes, sir. Now, we can go through the second approach because we will hardly use this approach. But in order to make you understand, I'm adopting this technique. We know very well that assets minus liability is equal to net assets. And we also know that net assets is nothing, technically it is your equity. Net assets is nothing but your equity. And what equity means? I just wrote assets minus liability is equal to net assets. And I just told you net assets is nothing but your equity. And what equity stands for? Equity stands for share capital plus other equity, or for simplified version, let me state reserve and surplus. Nowadays, reserve and surplus are known by the name of other equity. Is it clear to you? So equity means share capital plus reserves. So there is an alternative method of computing my share in the net assets of the subsidiary company. The first approach you have already seen. Under the second approach, what I need to do is to add share capital and reserve and surplus. Now suppose if I add share capital and reserve and surplus, it will give me the same thing, that is 10 lakhs. And my stakes will be 3/5, that will be 6 lakhs. Are you getting my point or not? So you must not let it skip out of your memory that net asset stands for equity and equity stands for share capital plus other equity commonly known as reserve and surplus. Is it clear to you or not? That is the significance of computing degree of control, because we shall need that time and again and again. So first thing first, so you need to understand the logics behind what we call every step. So under the second step, as I just told you a moment, we need to compute the degree of control. So once you have computed the degree of control and understood its significance, then what is the next step? And next step is the most prominent, vital and significant. Once you acquire proficiency in it, let me assure you, this particular chapter will be felt by each one of you as almost like a cup in the coffee. Like almost coffee in the cup. So now, have a look over here. Degree of control we just told. Under the second step, we have computed degree of control. Then what is the third step? I just told you a moment ago that third step is very, very important. And I also told you once you acquire proficiency in it, then this entire chapter will be almost like a what we call walk or stroll in the park. Just pay attention here. Third step. Third step is known as analysis of other equity, because in the upcoming questions I will use the word other equity more often than not, but these are initial questions, so I am simply writing here analysis of profit and loss account. Correct? Other equity stands for reserve and surplus, like general reserve, profit and loss account, etc. Now in this question, there is only one item of other equity, that is profit and loss account. So that is why I have written profit and loss account. Had there been more than one item, say profit and loss account and general reserve, then we would have had to do one more analysis. Besides analyzing the P&L, we should have in that particular case analyzed also what we call general reserve. Analysis of other equity, now we are picking up. What we mean by it, just pay attention over here. It is very, very important. See here, in order to understand that, let me stretch a line. When I stretch a line, basically my purpose is to present the opening date, that is 1/4/20 and 31st of 3/21. These are the respective opening and closing dates of the accounting year of subsidiary company. Of course, these are the dates also of parent company, no doubt about that. Now have a look over the balance of P&L in the subsidiary. Have a look over the balance of profit and loss in the books or in the column of what we call subsidiary. Let's have a look. This was the question which I wrote before you. Now we move over to equity and liability side. Under the other equity, we find profit and loss account. 4 lakh is the balance of P Limited, while 5 lakh happens to be the balance of subsidiary. We are more concerned with only subsidiary company. Remember one thing, everything is being done from the perspective of what we call parent, but items which you will consider more often than not will be of subsidiary. Correct? So, in this case, once you have taken a look and found out the balance, 5 lakh is the balance. This balance is as per the balance sheet as at 31st of 3/21. So I write below it, balance in profit or loss account on this date happens to be 5 lakh. So I write here 5 lakh. Simple? Very simple. Now next step what I need to do is to find out the balance which existed on this particular date. It must be given in the question. In the additional information, it is clearly given that P&L balance of subsidiary company on 1st of April 20 happens to be 2 lakhs. So you write here 2 lakhs. Now if I would ask you a very simple looking question, if opening balance is 2 lakh and closing balance at the end of the year is 5 lakh, how much subsidiary company earned profit during the accounting year? During the accounting year means from this particular date till up to this date. How much profits must have been earned by subsidiary? Obviously your answer will be 3 lakh. It cannot be 9 lakh. Correct? So if I take the difference of these two items, obviously it will lead me to the fact that subsidiary company during this particular period, starting from 1/4/2020, falling on 31st of 3/21, during this particular period, subsidiary company must have earned profits of 3 lakhs. Profits of 3 lakhs. That is why the closing balance or the balance at the end of the financial statement or end of the year is 5 lakhs. Are you getting my point or not? And here is the most important point. That is the reason why I said a moment ago that once you acquire proficiency in it, then this chapter is almost like a cup of coffee. See here. Opening balance 2 lakh, closing is 5 lakh, which leads us to the fact that subsidiary company has earned what we call 3 lakh as profits during this particular period. Correct? You must not let it escape you must not let it escape this particular fact that this 2 lakh logically was earned in the last year, because this is the opening balance of the current year. This must have be the closing balance of last year. This opening balance is nothing but balance brought forward of last year. That means this particular part, 2 lakh, was earned last year itself. And this 3 lakh has been earned in the current year. You can also say it like that. Previous year balance, for simplicity's sake. You can also write it as what we call current year's profit. That is why closing balance is 5 lakh. Is it clear to you? I have already told you, when we acquire stakes in an entity, not only we get what we call share in the share capital, but we also acquire share in the other equity, that is general reserve, profit and loss account, etc. No doubt about that. But due to some or other reason, it becomes imperative for the parent company to segregate the profits earned by subsidiary company into pre and post acquisition period. Now you must have got the relevancy of the first step. Is it clear to you? Due to some or other reason, I said, it becomes imperative, necessary for parent limited to segregate the profits. In fact, the other equity, I will use the term profit sometime, because we are acclimatized to using the words profits. Correct? Whenever I would say profits, it automatically would mean actually other equity. So, due to some or other reason, it becomes, as I said, necessary for the parent limited to segregate the profits earned by subsidiary company in the current year into pre and post period. Why? Obviously, answer will be furnished to you after little while. Once you have drawn this particular chart, now the next step is, because this sheet is over, I will have to keep this sheet here because I have to still make you understand something. Now I told you a moment ago why we are doing this analysis. In fact, what we are doing under this particular step, we are trying to actually segregate the current year's profit or the profit earned in the accounting period by the subsidiary company into pre-acquisition and post-acquisition period portions. We want to know how much out of this 3 lakh has been earned in the pre-acquisition period and how much has been earned in the what we call pre-acquisition period. Just have a look over here. In fact, this sheet is about to be over, so let me put it this way. Correct? Because I will have to keep this sheet before you. I hope you are able to see it, correct, right now. Remember one thing. Profits, obviously, which will be earned in the pre-acquisition period, that is period preceding the date of what we call control, will be referred to as pre-acquisition period profits, and profits which have been earned by subsidiary company in the period falling after the date of control will be referred to as I said, post-acquisition profits. Now, could you tell me in this particular case, 5 lakh is the profit as per the financial statement drawn on 31st of 3/21. We have broken this into 2 parts. That opening balance was 2 lakhs. So in the current year, subsidiary company must have earned 3 lakhs. Just a moment ago, I also told you these are the profits which were earned by subsidiary company last year and not in the current period. Because these profits have been earned last year, without an iota of doubt, these profits will be termed as pre-acquisition profit, because these profits were earned before you acquired the control. Obviously, you acquired the control on 1/4/2020, but rupees 2 lakh worth of profits must have been earned in the last year itself. So quite obviously, there is no problem with respect to opening balance. Opening balance shall always be considered as pre-acquisition period profits, because these profits are brought forward profits. These are last year's profit. So the question now comes over to the current year's profit. Now the current year's profit in this case, we will have to divide this into pre and post, but the problem is that in the present case, we do not have any pre-acquisition period. Entire current year's accounting period is starting from 1/4/2020 to 31st 3/21. Entire accounting period is post-acquisition period. So we may say that entire 3 lakhs are post-acquisition profits. Okay, I will write here itself. Entire 3 lakhs will be termed as post-acquisition profits. You must understand it very well. This entire 3 lakhs will be termed as post-acquisition profits. Post-acquisition profits. And obviously, this 2 lakh will be termed as profits acquired prior to the what we call date of control. These are obviously pre-acquisition profits. So you have broken 5 lakhs into pre-acquisition and post-acquisition parts. Why we are breaking them out into these 2 segments, obviously each one of you are quite keen to know, but the logic will be unleashed after a while. Correct? Right now you have to concern with the fact how you have to actually divide and segregate. So this is your pre-acquisition profit, this is your post-acquisition profit. Is it clear to you or not? Till up to this particular point. Now, let me again have a look over this rough sheet. Okay, this is the rough sheet, correct? I will take another rough sheet. Actually, it is creating a problem. So I will take this rough sheet. I put this sheet over here. Suppose closing balance, this is 31st 3/21 and this is 1/4/21, correct? Suppose closing balance is 5 lakh of a particular entity and opening balance is 2 lakh. Obviously, I would say in the current year, this particular entity has earned 3 lakhs. This was also the case in the present question which we are picking up, in fact, which we are considering, correct? In the present question, which we are doing right now, problem is that we have acquired control in the beginning. So that is the reason why we are saying that this 3 lakh which was earned from this particular date till this particular date is a post-acquisition profit, because this entire period is post-acquisition period. So out of current year's profit, this time there are no pre-acquisition profit. We can say out of current year's profit, there are no pre-acquisition profit. Current year's profit is 3 lakh. This is obviously pre-acquisition profit because this profit was earned prior to the date of acquisition. So out of 5 lakh, we may say 2 lakh is pre and 3 lakh is post. This is one part. Now suppose same situation is there. Closing balance 5 lakh, opening balance is 2 lakh. Now suppose for a while that your date of control, this is opening date 1/4/20 and this is 31st of 3/21. Say or presume you acquired control on 30th of September 2020. Suppose if your date of control would have been this one, then in that case, how you would have segregated? See here, it is not a very difficult task. If we presume date of control, this one, correct? In that case, how I would have proceeded? I would have taken the closing balance as I did. I will consider the opening balance as I did. Absolute similarity. Again, I will take the difference. I will try to find out how much profits have been earned by subsidiary company in the current accounting year. Subsidiary company has earned 3 lakhs. Now, problem is that this time, this current accounting period is not entirely post-acquisition period as was the case in the present case. This time, accounting period, see here, accounting period means period is starting from the opening date and ending on the last date. This is the current accounting period. And you have acquired the control here. That means out of current accounting period, 6 months period is pre and 6 months period is post. This is pre and this is post. So in that particular case, if we would have had acquired the control on this particular date, then what I would have had analyzed that current year's profit is 3 lakh. I would have divided this profit into 6/12 and 6/12. In that case, 1,50,000. 6 months related to this period. This part will be considered as post-acquisition profit. And this particular part, 1,50,000, which is related to these 6 months, will be considered as pre-acquisition profit. And obviously, this 2 lakh, because this is the opening balance, this will always be considered as pre-acquisition profits. Are you getting my point or not? So, by now you must understand that you need to segregate the profits of the subsidiary company into pre and post. But the $1 trillion question is, value of million is eroding day by day. So that's why I said trillion million. So trillion million question is, why the hell in the world actually we are doing such a long, tedious, highly what we call exorcible exercise? See here, reason is that reason is still actually, honestly speaking, I'm not giving you. I will give you in the next step, but I will give you some inputs in it. Actually, the profits which are earned by subsidiary company, correct? Whether it happens to be profit or loss account or general reserve, no doubt about that. Whatever profits which are in the pockets of the subsidiary company, we have stakes in it. without an iota of doubt, because we have invested in the subsidiary company. You know this. Problem is that profit and loss account and general reserve by nature are of revenue nature item. Again, this goes without saying, isn't it? Both these items are of revenue nature. But from the perspective of the parent, profit and loss account and general reserve of subsidiary company are entirely not of revenue nature. Are entirely not of revenue nature. Why? The reason, try to understand. Because whatever profits of subsidiary company are there, some of those profits have been earned in the pre-acquisition period and some of those profits have been earned in the post-acquisition period. Some profits has been earned or must have been earned in the pre-acquisition period, and some of the profits must have been earned in the post-acquisition period, as we just saw. Logically, profits which have been earned prior to the date of control, cannot be considered as of revenue nature from the perspective of the parent company, simply because of the fact that these profits are accruing to parent without any effort. Remember one thing, please try to, I will just take up the case once again. This is the question which we were solving, correct? 5 lakh is the closing balance, opening balance is 2 lakh. I told you, during the year, subsidiary company has earned 3 lakhs worth of profits. These profits are after the date of acquisition. These profits are termed as post-acquisition profit. And these 2 lakh, the opening balance, because these profits have been earned in the past or prior to the what we call date of control, are referred to as pre-acquisition profits. Remember one thing. Actually, we have broken down 5 lakh into these two elements, opening balance and profit earned in the current period. We know that we have stakes in this 5 lakh, but we are breaking it down into pre and post period. We will have stakes in both, no doubt about that. Why we are breaking it down? Because we know that out of this 5 lakhs, some of the profits are there which were acquired prior to our acquisition. So out of this 5 lakh, 2 lakh have been earned prior to the date of control and 3 lakh have been earned after the date of control. Logically, and we are having stakes in entire 5 lakh. Remember one thing, whether the subsidiary company has earned the profit in the past or in the current year, whatever profits are there at the end of the year, you are going to have a stake in it. But the point here you need to note, and note very carefully, is that these profits which were earned by subsidiary company were without your indulgence. At that time, you were not the parent body. You were not dictating the terms, neither you were directing the what we call financial and operational matters of subsidiary company. So logically in accounts, such profits which accrue to an entity without any effort, without any indulgence, are referred to as capital nature profits. Capital nature profits. And the profits, these profits, post-acquisition profits, will be referred to as revenue nature profits from the perspective of the what we call parent company. Reason is that these profits have been earned after the date of acquisition. It means after the date of acquisition means now you were directing the subsidiary companies, what we call financial matters and operational matters, you were indulging in it. It means you were having some sort of role in earning what we call, in earning of those profits. That is why post-acquisition profits are referred to as revenue profits and pre-acquisition profits are referred to as capital profits from the perspective of the what we call parent company. So all in all, we need to understand so far what we have understood in this particular question. So far, remember, we haven't yet completed the solution because we are analyzing the things too. I told you that we have to analyze the accounting period, get a good idea what exactly is the pre-acquisition part, what exactly is the post-acquisition part, find out the degree of control. Why we are doing that, I need not require to tell you, correct? Third one is analysis of profits. Analysis of profits basically means segregating the profits of subsidiary company into pre and post-acquisition part, and the point is that such profits which have been earned by subsidiary company in the post are considered as revenue profits, and such profits of the subsidiary company which are related to pre-acquisition period are considered as capital profits. But the point once again revolves to the fact what we mean by this capital and revenue profits. What benefit it is actually